Okay, hello everyone, and welcome back to our fourth, I think, NewDeal Invest live Q&A. For all of you who have been here before, welcome back, and to those of you who are just looking right now for the first time, this is Mads Christiansen, the guy on the left. He is our Chief Investment Officer. Say hello.
Hi guys, thanks for tuning in, and yeah, hope we get a lot of good questions like we usually do.
Yeah, I'm sure we will. And I am Jesper. I am a UX designer and part of the portfolio team here at NewDeal Invest as well. Mads and I have dedicated the next hour or so to answering all your questions and discussing all the topics that may arise from it underway. Please ask questions in the YouTube live chat and we'll get to them as soon as possible. You can also ask in Danish if you prefer. Uh, and as a disclaimer, I just want to share that none of this is or should be considered investment advice, and that you should always invest at your own risk. Um, and I believe we have some questions left over from prior, so I think we'll just jump into those right away. We have Rasmus asking here. Do you follow dLocal, and what do you think of the company, Mads?
Yeah, and I think there was some other questions about top picks from NewDeal Invest,
Yes,
and
we also have a question saying what are the top picks of NewDeal Invest? Where are we overweight right now?
yeah, and some underweight overlooked tech companies, I think was the third question. So seeing those questions, I just wanted to start out with just a couple of slides to show you why I think the companies that we're going to present are undervalued. So I'll just share the screen here, and you'll probably heard a lot the last couple of years that tech stocks has been in a bubble, and that they were way too cheap, and now they've come down to realistic prices. And that could be the case, but I think there are other explanations, and I'll just take you through these other explanations very shortly here. So this is the Amazon 25-year chart, something like that. The blue line here is the gross profit, and the red line is the share price. And you can see there's a really good correlation over the past 25 years between the gross profit of Amazon and the share price. And then you see these dislocations where Amazon gets way too cheap. And just comes up 900% in 2 years, and 370% in 2 years after the great financial crisis. And then looking at this chart, you sort of wonder what are folks doing? Why are they selling this out here? And you hear a lot of explanations. You hear a lot of people talking about when Amazon is down, that finally this bubble cracked, the PE was so and so, and stuff like that. And they will just be amazed when the share price goes back up and gets back to the normal correlation here. And yeah, and we're at one of these places right now where people are sort of, it was a bubble and it was stupidity. And I just want to show you an alternative explanation. And this is from a presentation that I recently had, where I postulate this: tech stocks are typically undervalued because high variance reduces median expected returns. And therefore indexes of stocks outperforms. So I won't go into this in detail, but the problem is that the world is, or stock returns are, you need to look at geometric returns and not linear returns. And when you look at geometric returns, then you actually get some other stocks do different jobs for portfolios that you might think, and when volatility increases, then the expected return that the market has, or the expected correlation between expected return and volatility of the stocks you invest in, it actually yields a different result if you think about it geometrically instead of linear. And this here is the geometric return of what you might think should be a normal portfolio return. So the point of this here is that when volatility increases, then it really does something negative with portfolio returns. And a way to mitigate this is actually to do an index of these high volatility stocks. And the Nasdaq is one example. And I would postulate that's why Nasdaq is overperforming, because tech stocks has at every point in time been too cheap compared to their potential outcomes. But the reason for that, and the reason for that this undervaluation is at all times justified and is the right thing to do by the market, is that if you put these stocks in a portfolio, their high variance will deteriorate the return of the portfolio in a geometric way, and that's what we get. This is another index, the a cloud index of upcoming cloud stocks. And yeah, so my point here is that when Amazon is suddenly undervalued at times here, it's because volatility has increased. And when volatility increases, then the expected short-term return of these stocks deteriorates really a lot. And therefore, the market has to sell them out. So even though this looks stupid, it's actually reasonable to do when you have a normal portfolio. Now, what we try to do in NewDeal Invest is we don't have a broad portfolio, so we mitigate some of this. But when the market just decreases the value of the stocks because they have come with high volatility, then we can't do anything in NewDeal Invest either. We're just a broad tech portfolio. But hopefully right now we're somewhere near the bottom, and yeah, I'll just show you two of the same types of correlations here. This is C limited, and it's shorter time frame, but you have the gross profit here, and then you have the stock price, which is following the gross profit, and then it's just the stock price is just slamming down and is down here right now. This one here is HelloFresh Group, and you see exactly the same picture here. And if you go through most of the small cap or medium cap tech stocks, the tech stocks which are from a couple of $1 billion and upwards in market cap, then you'll see the same picture here. Unless you look at the elite stocks, the sort of well-known stocks that are the highest, the fastest growing and most popular SaaS stocks and the AI stocks, where they have recovered this correlation here between the gross profit and the share price. Yeah. So my point is here that most of the stocks that we look at here are really cheap and attractive because of a normal market reaction to higher volatility. Yeah, but if we do things right with the volatility, it's not going to hurt our portfolio going forward. So that's really the great opportunity. So with that said, then when I start talking about a few stocks that I think are really interesting, you should not put 10% in them. You should of your portfolio, because then you get a really high volatility and you are quite likely to have a poor outcome. When investing in high volatility stocks, you really need to have a broad portfolio, and you should not have like 10% in a single stock. That will just hurt your most likely, your median outcome in the future. So these sort of recommendations should be used for a very small position, and that's how you should address investing in tech stocks. So if we look at dLocal, then I really like dLocal because dLocal is so hated by the market right now that it should be as cheap as it could possibly ever get. dLocal is doing payments in especially in Latin America. The company is founders are from Uruguay, and but the biggest market is Brazil, where they started up. So if you're a company like Spotify and you wanna sell in, or you're an e-commerce player, you wanna sell in Nigeria or one of the Latin American countries, then there is a lot of different payment methods, and you could either go negotiate a plugin and get a plugin for each of these payment methods in these countries, or you could go to dLocal. They have gathered all these different payment methods into one API. So you're just and then they help you with the local tax and VAT and different sorts of regulations and whatnot. So they really help you get payments easier. And dLocal is focusing on the less developed part of the world, economically less developed. So they have countries in Africa and Latin America and Asia as well. They have Bangladesh, and they have Egypt, and they have Nigeria. And I love it from a portfolio perspective because we get some diversification and some exposure to these upcoming countries as well. If you have Mercado Libre and you have Nubank, etc., you should be a little bit aware that you might get a high exposure to Latin America by incorporating dLocal as well. Now, there was a short report on dLocal 1 year ago or something like that, and the analyst has a really hard time getting or breaking down dLocal's economy because they are in these countries with high inflation and very volatile sort of financial markets. So dLocal's earnings are all over the place all the time and hard to predict. So this stock really comes with an extremely high volatility. You have a small risk that it's actually a fraud. I think they addressed it. I don't think it makes sense it should be a fraud, but you have a short report, and that just increases the volatility. Then you have these unpredictable markets, so that increases the volatility. So, and they're operating in markets that could be sort of obliterated. Brazil has not sort of historically been extremely stable. So lots of volatility in dLocal and lots of unpredictability. And therefore, it should trade at dirt cheap prices compared to what its future earnings could be. And if you construct your portfolio in the right way, you buy like 200 dLocals and diversify very good, then you'll get a very good return because you mitigated the variance that it comes with. But don't ever buy 10% of your portfolio into dLocal. That would be really too dangerous. So we like dLocal, but only as a very small position.
Yeah, I think concentration can often be a little bit overvalued by newer investors.
Yeah.
I mean, I think a wise man once said something like, if you owned 1% of Amazon in 2000, you're a rich man now. And if you owned 1% of Blockbuster, it doesn't really matter, right? So I think being diversified, especially if you're trading highly risk stocks or in areas or geographies that are considered unstable, it's a really good idea to spread out
Yeah.
as much as you
Yeah,
possibly
definitely.
can.
And the math applies to it. I only scratched the surface on the geometric returns and the non-ergodicity problem, but there is a really lot of math, and you can find it in our YouTube channel on NewDeal Invest, where we go deeper into it. Sorry,
Yeah,
Jesper.
No, I was just thinking, with all that said, do you have like a quick list of the stocks that we are heavily weighted in right now? Just maybe the top three or something like that.
Yeah, I've got them here. So we would typically be high weight in stocks that has just gone up a lot. Um, because then they would be a big part of our portfolio, especially if we still believe in them. And a good example of that is Carvana, that just rose like 40% on the earnings and was one of our top picks before that earnings. So it's one of the biggest positions. It is the biggest position right now.
Yeah,
And then we have another very small company that's called Cardlytics, which is also in the top five. Cardlytics is a company that does commercials on the bank's mobile applications or your browser application, and they've been nearly bankrupt. They did an acquisition and had problems with the payout for that because their own share price tanked. And 2 years ago, 3 years ago, their app was the user interface was really outdated and not very functional. And their biggest customer, one of them, Blockbuster, no, not Blockbuster. I just got that on my mind. Starbucks
yeah,
left them, and thus it's also a stock where volatility became insanely high, and therefore it was trading like it was going bankrupt. And we've owned this stock from like $3 or $4, and it's trading at 15 now, something like that, 14, almost 15, and it still seems very cheap compared to what they are building, but it also comes with a very high of volatility. There are some cases where they don't succeed. They are depending on a few big customers, both on the banking side, but also a few people. They have some really big clients that they need to hold on to. So it's one of these again, and the way we tackle it is that we rebalance very often, and we keep positions small. So when we're talking about our largest positions, they would typically be less than 5%, even though they are the largest, because we mitigate the high variance here. And
yeah,
then C Limited is a top five position as well. And yeah, I I don't I don't think that the long-term outcome of C Limited has a very high variance. So we think about variance in two buckets. There are variance on the long-term outcome of the companies, and when we talk Cardlytics, that variance is high. When we talk C Limited, I don't think that variance is high. They're dominating in their geographic area. They got three cooperating platforms. It's a really strong stock, in my opinion, the best balance sheet of the competitors in Southeast Asia. And Carvana has moved now from being a stock where I was in doubt of whether they were going to make it long term to now I'm really confident that they are going to make it long term. And the market has not started pricing that in yet. So I think that should come. Um, yeah. And then there's the short-term volatility, which is the price action, where 2022 just killed us because stocks just went down. But now it's a tailwind for us that they've come down such a lot. But we also always sell into the strong periods because we see markets tanking our stocks, even though the sort of the reasoning for it doesn't make sense. So I think C Limited was profitable, I think 3 quarters ago. They
yeah,
showed that they could just flip and be profitable. So they should not be trading at where they were. And if you analyze the C Limited earnings and sort of separate it the right way, then you see a company growing its core like 40%. I made a YouTube video on the channel here after I think it was Q3 earnings, where I go through this in detail. So me listening to the analysts' explanations of why Sea Limited could not be profitable and stuff like that just didn't make sense at all. But nevertheless, they just cut the price in half, and that's how it is to be a tech investor. You need to always be flexible and be ready for the market to have a different view than you, and still have the ability to buy. So we've been buying Sea Limited while it was falling, and now it's nearly doubled again, and we've been selling along the way up, but it's still one of our biggest positions.
Yeah.
And then we really like HelloFresh Group, which is one of the companies I showed you the chart of the gross profit. And this is one of the companies where I really disagree with the market. I think they're getting it totally wrong. They're misunderstanding meal kits and the reasoning why they are not growing a lot. And that said, if we're going into a recession, I talked to one of the meal kit CEOs last week, and his biggest fear was actually that that consumer demand would stay dampened. And when we saw the job numbers last week, we had the content delivery network companies, Cloudflare and what are they called? Yeah.
I'm not
I
sure who
can't.
you're thinking of.
No, it's a small competitor to Cloudflare. They actually have headquarters next to each other almost.
Hmm.
But they were really weak, and that could be a signal that consumers might be getting weaker than we think. So we are looking an eye out for that as well. But that's what could hurt meal kit companies like HelloFresh Group and the others. So we could still get a downswing in them, but long term, it's one of our really good bets. I'm not in doubt about the long term prospects for HelloFresh Group.
I think it's quite interesting how you mentioned that Carvana and Cardlytics are some of the top positions in continuation of what we talked about before. That's what we're able to do in the fund because we have such a big or so many positions, right? Basically picking up stocks at the like those two examples at such low bottoms that people think they're going bankrupt, right? And then, of course, if our thesis is right, they'll end up as huge positions for us, all things
Yeah,
considered.
yeah,
But
exactly.
yeah,
And so people might think that us having a 4% or a 5% position is like a passive investment, but it's not, because we could have a 1% position, but it's it's 5 times bigger, so it's actually very active.
yeah,
It's just at a smaller level.
yeah. I mean, you're actually almost answering the questions before they come in because someone asked you to talk a little bit about Carvana, and I think you've already expanded a little bit on that. And we have someone asking
Yeah,
on our
yeah,
thoughts on Southeast Asia as well. So
yeah.
you're ahead of the game.
Let me just do Carvana. So a couple of years ago, Carvana was trading at $350, and they were growing very much. And sort of what investors were visioning was that they could be the number one retailer, used car retailer in the States, the one that consolidated that whole market. And you had some competitors which were in there, and people were in doubt whether CarMax, what they could do and not do, whether they could just adopt the same business model. And then the world just went up in flames, economically speaking, and Carvana was in really big problems. Now they're out of the woods. They've bought ADESA, which is a car auction, a nationwide car auction company, which means they have physical facilities in all the right locations in all of the states. and the sparring competitors that were coming, they're wiped out, they're gone, and everybody knows that that trying to spend like 10 or 20 billion dollars trying to build a Carvana, that could really be suicide, economically suicide, because you've seen how tough it is. So Carvana now has no competition. They have the physical infrastructure ready. They have paid for it. So when you see the Carvana earnings now, they actually have the physical capability to triple their car manufacturing without buying more real estate. So but they do need to hire employees to make that work. It's a low margin business still. And right now their margins on the cars and as a company is the best in the industry over there, and they are the most popular solution. They're the most convenient solution. So they're the best, they're the most profitable, and they have taken a lot of the costs in advance. And their market share right now is about 1%. So they can, and the biggest is CarMax. I don't remember how much they are, but they're just a little bit bigger. So it's a highly fragmented market. You have the by far the best solution. No competition is coming in. So this is a way better company than it was 3 years ago. So so Carvana is really, it's not a stock that we are selling at the moment, by no means, because I think it has a great future from here, and
Yeah.
a lot certain.
And Valente asked if you have any thoughts on Grab as a long-term growth stock, and again, if you maybe have some thoughts on the Southeast Asia region as a whole.
Yeah, Southeast Asia has a really young population, and they're not so far in their digitization. They're getting somewhat there. Doing an e-commerce business is hard there because the infrastructure is not really good. So and then they have large and young populations. So
Yeah.
when you go back to China and see why was China suddenly growing so much? Well, it was because they had a really young population back in the zeros. When you go to Japan and when they really rose to the occasion, it was a large young population. Same with South Korea, and now it's Southeast Asia. And a company like Indonesia is, I think it's nearly the size of the United States population-wise, and they the population is their discretionary income is very, very low. So your basic income is what you need for clothes, food, housing, dog food, and that's it. And so the discretionary income is what you have for smartphones and things you don't need, hi-fi and clothes and smarter clothes and stuff. So when their salary grows a little bit, then their discretionary income might double or triple or something like that. So e-commerce in Southeast Asia is going to be just a long-term tailwind. And that goes for Grab, it goes for C Limited, it goes for GoTo in Indonesia and all the other platforms. It's just a market with a lot of tailwind. And then it's fairly stable politically. So it's really hard to get exposure there. Being a stock investor, you can invest in C Limited, you can invest in Grab, you can invest in GoTo, which is listed on the Indonesian stock market. Then you can invest in, we have a little bit of Gravity, the computer company, because they are an exposure to Latin America and Southeast Asia. But it's hard to get good exposure there.
Yeah.
And we get that from them. But Grab is winning. Grab is they're the Uber combined with a financial platform and a little bit of DoorDash as well. So they have the local commerce, they have the mobility, and they have the fintech platform. And I talk about this a lot. When you have when you have one large platform, it's really good. But when you both have a fintech and a mobility and a e-commerce platform working together, cross-selling, all that stuff, that's just really powerful. So we like Grab long term.
What's given how they're, fairly similar and in the same region, what's really the key difference between Sea Limited and Grab then?
Yeah, C Limited comes from the e-commerce side, so it's like you have Uber, and then you have Amazon, and there's a lot of talk in the market that C Limited does not have logistics, but they do. They've been building logistics for a long time, mainly in the cities. You can't build logistic networks the same way in Southeast Asia because the infrastructure is rather poor. But they're building it and they're leading it, and they have the big balance sheet. And also when you're building a logistics business, you need to have volume, and they just have the volume for that. So they're good at that. And Grab comes from the Uber side. They have a lot of consumer touch points, and they have the fintech platform with C Limited also have. But and then they are doing the DoorDash thing with local marketplace, delivering lots of other goods, and using their fintech platform to support the merchants selling on their platform or driving for their platform. And yeah, so I think they will be the two winners. Sea
Yeah,
Limited has a food delivery platform in Vietnam, but I think it's the second largest there. Um,
but
so
Grab
they're not.
also dominates in Vietnam, right?
I think so.
I think they do.
I'm not that sure, but they are sort of dominating in those regions
Yeah.
in Thailand and yeah
I think C having its start in the gaming industry and then moving into these other industries is really interesting for someone like me because I believe a whole lot in engaging users, and I think it's difficult to tell when you haven't really tried the product in like a detailed kind of way. But I think that their Shopee is supposed to be a lot more like entertaining in a way, or engaging at least, and sort
yeah
of boosting sales that way. And I think that's at least a unique approach. Um,
yeah yeah that spot on. So e-commerce is about getting somebody's attention and then selling something to them. And Shopee has Shoppertainment, where it's a fun place to be. It's a fun app, and like you say, it's their gaming background. It's like a game, and that is the new way. They have lots of small games where you can get discounts. If you're buying something and you can, I don't know if they have this more, but anymore, but they had a couple of years ago. If you could get a friend to shake their phone,
mhm.
then you would get an additional discount depending on how many friends you could get to shake their phone. So it was just buying engagement on their platform.
Yeah,
And Grab is actually the same like Uber. They have engagement. They have people shopping pizzas or wok noodles or what they're shopping, and also driving, watching the screen. So they're also an aggregator of attention. So, but in different aspects, and that way they're probably going to be very different for quite a long
yeah.
time. Yeah.
All right, cool. Let's put a wrap on Southeast Asia, and let's move over here to Lucas asking on thoughts about Fubo. Uh, yeah, do you have any?
Yeah. I do have some. I think Fubo is yeah, it's interesting. They have a they aggregate sports TV, and they make a personalized experience for you. And and they are using AI to try to do that. So I think they're really good on the product development side and the and their ability to create value for their audience. They're in quite a tough spot, given that they're up against some really powerful companies like Disney and the streaming giants of the state that has sports, and you have YouTube and Apple also coming into that. What what is you what is unique about Fubo is that they could be the place that all of these big players use as their platform, because what you really want is, the optimal thing is if you have somebody watching a sports event, and then he wants to see something else. You want the platform to help him find what he wants to see. But if you're on Disney's, one of Disney's platforms, it will only refer him to Disney. If you're on Peacock channel, it will only refer him to Peacock. And Roku has something of the same, that it can help you go cross channel and find what you like. So the value prop for the users are really big. And you could also imagine that it would be a great idea for all these big players to just be on the Fubo platform and have Fubo help people find what they want to see, and then monetize that, instead of trying to lock the user into some platforms and really deteriorating the user experience. But Fubo is too small for that, and now they're suing the big players. Fubo is extremely hated by the market because they've been unprofitable and are still unprofitable. There's been doubt whether they needed to raise more capital. They're doing quite a good job getting to profitability. And then there's really doubt whether they're going to be squashed between some of the big players here, or how it's going to fare. And that actually means that it's I see it as a really good risk reward, but with an extremely high volatility on the long-term outcome. This one might go bankrupt, or might be sort of just crushed in one way or another. So it's a very small position, but probably also a high reward if they manage to get through to the other side.
Yeah. All right. Very cool. Let's see. Uh, any ideas on how to combine tech and arms industry? I think militaries, I guess, is being referred here. Specific stocks that might have an edge in AI or something like that. That is Chris asking.
Yeah, you have Palantir.
Yeah.
That is the logical move, but we don't really look at arms or stuff like that. We want to look at tech, and yeah. So
Yeah.
I don't have any. Do you have any ideas, Jesper?
No, I think it's really difficult because it's, like Palantir, all of it is sort of shrouded in secrecy, right? Unless they have big, huge contracts with the American military or something. And, there's a bunch of big players like Microsoft also having that. Google just made a huge military contract as well and got in trouble for it, at least with some employees who rioted or something like that. So, I mean, it's like unless it gets publicly announced, it's a little difficult to follow. And I guess some of the like the drone companies and all that, they're either privatized or like straight out just consumer products that are being modified somewhere else. So yeah, I don't have any expertise on it either. It'd be really interesting if I guess if a player came through in this environment with sort of a tech AI edge on top of all this. That'd definitely be sort of two worlds meeting right now. But
Yeah,
yeah,
I think with the secrecy, like you're saying, and the large political agendas, then you probably have a space where a lot of people will know what is going on way before a private investor
Mm.
knows it. It's like it's like or it's like it's like people without connections. It's like a waterfall. You get to know most news when things are priced in.
Yeah.
And I think that this could be one of those industries that has that flaw. I think medical is another industry that must have that flaw. There must be so many people that knows what the outcomes of this and that trial will be
Hmm.
before the general market knows it. So I kind of like to stay away from 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 themes where you just have a disadvantage
Yeah.
from that.
Yeah, you should, if you're really interested in that, Chris, as concrete suggestion could be to follow the Nancy Pelosi Twitter account, which sort of tracks all her investments because she's definitely a kind of person who knows these
Yeah,
kind of things way before anyone else, and
yeah,
isn't afraid to sort of just move on it. Uh, I think technically it's her husband's money or something like that, but I'm pretty sure the information comes from her. So
yes. But how about I'm curious about the new
yeah,
Unity CEO and your take on that. Could you
sure.
tell us a little bit about it and what you think?
So, following 8 months of sort of searching for a new CEO, following the whole pricing fiasco Unity had, they finally found someone here May 1st, a guy called Matthew Broomberg. He is a relatively unknown guy, but I've obviously looked him up since. He had his sort of his start in Major League Gaming, an esports organization, which is actually pretty huge by now. And then he moved on to BioWare, which is part of Electronic Arts. And in that way, he actually reminds me a little bit of the former CEO, John Riccitielli, because he was a top executive from there, and so did Matthew end up being. He started as I think, a general manager of BioWare, and then he moved up to becoming an SVP in Electronic Arts. So I think the Unity board may have a type, I guess you could say, because they do sort of have the same vibe. But more importantly, Bloomberg also was the chief operating officer in Zynga, which is this huge Facebook gaming, mobile gaming studio, which was acquired by Take-Two. I think, what is it, 2 years ago or something like that? 3 years ago, maybe.
Yeah,
Uh,
yeah.
yeah, and that is a really successful chapter of his life, I think, and a company that is now acquired, which also sort of leans into some of the things he's done since, because he is on the board of a bunch of big, well-known apps, and he's a senior advisor at Blackstone. So he definitely also has some sort of finance or an understanding of like the mergers and acquisitions world. And that again reminds me a little bit of John Riccitielli. At least that was his strategy. So I don't think they're the same kind of guy. I think at worst, Bloomberg is probably a more successful version of the kind of person that Riccitielli is, or the kind of strategy that they're pursuing. But I like really don't know what to expect. I'm really excited to hear from him here. I think it's on the 9th. Unity is reporting earnings.
What
Uh,
do you think if Unity board thought of a problem that they needed to have solved in the company by the new CEO, what would that problem be?
That's an interesting question, but I think the biggest issues have been fixed under the interim CEO, Jim Whitehurst. He really took he made all the tough decisions and really streamlined the product portfolio and optimized company mass layoffs and such. And I think those were really the sort of the hot and burning issues that needed attention. So I think, I mean, I liked Whitehurst because he was such a product-focused guy, and I think that's where the attention needs to be now. They moved past from the whole consulting business with the professional services and such, and so now they just really, really need to focus on making Unity, the core product, as strong as they possibly can, so that they can have as many big clients sign up for newer versions of Unity from Unity 6 going forwards, so that they can all jump on this new revenue share model, which is really what led to all this action in the first place. So, the what I believe was probably the biggest mistake of the former leadership was how they messed up this whole revenue sharing thing and actually had to retract the cost that said that all previous projects made in Unity also had to share revenue unless they make the product good enough for people to upgrade to. All that revenue they are going to miss out on forever. And there's so many very, very huge, super successful Unity games out there right now that aren't making any money for Unity outside of plans for per seat, like developer seats. And yeah, there's just a lot more to gain from that, I think.
Yeah, yeah. I think I got yeah. So naturally the first mistake was not to monetize at all.
Hmm.
From the get-go, they've been too focused on their
It's just not in
original
the
mission.
it's not in the DNA of the company. Like going
No,
public was a huge disruption as well because
yeah,
it's always
but
been sort of a community driven, open sort of
yeah, for
service.
developers
Hmm.
and not for the company type of business. But
Yeah,
that really needs to change because they need money for R&D to drive the ecosystem. So they need somebody who wants to earn money.
yeah,
But I think they face another problem, which is that since ATT, the gaming industry has been in kind of a hard spot with low monetization, and I think that maybe it's become harder to build a new game, a new success game because monetization is so hard. It's so hard to get there. It's the need or the willingness to invest a lot of money in trying to make a big game has might be less now. So that could be a problem for Unity going forward, that you won't see so many new games coming up. But a good thing for C Limited with their Free Fire and
yeah.
and Fortnite
I
and the likes.
I'm not actually I don't really, I mean, obviously the whole ATT had an impact at the time, but now that the ad market seems to be in recovery, we've seen from Alphabet's earnings, from Snap earnings. I think Unity will come back as well. Now that they've had the time to sort of bottom out with all the confusion from the acquisitions and all the mess that has created. Iron Source was a profitable company prior to being acquired by Unity, and I do think they'll come back quickly. But I guess
Yeah.
that truth may be revealed here in a few days.
Yeah,
So
they have a lot of attention, just a lot
yeah.
of business, so they should be able to monetize it.
All
I
right.
think Mads Corfitsen asked a
Oh
couple of
yeah.
questions about how do you foresee interest rate development over the next few years and its impact on tech stocks. So on interest rates, I haven't got a clue. really. And I think most of the financial markets don't either. It's a big topic right now whether we're going to see the rate decrease again, or we're going to have rate hikes. Now the impact on tech stocks, it's something that people talk a lot about, and I think that short term it matters. It matters for price action over the short term. Now, what I showed in the beginning was that one of the things I think matter for tech stocks is the feeling of uncertainty in the market. So what the market thinks the volatility is, or what it could be. So I actually think that if we get a period with stability, however that is, that would benefit tech stocks. And then people will say to me, but mass growth stocks, they have such high debt. But then I would say, show me. Yeah, you could show me one tech stock which has a high debt, but if you look at tech stocks of today, they don't have debt. They have cash piles because they are not able to borrow any money. They don't have any assets they can lend money towards. So they typically have a lot of cash. All the SaaS companies has cash. C Limited has cash. So tech stocks has cash. So it's not because interest rates increases. And then people will say, well, you need to you put this into a discounted cash flow model, and then you have to that modifies the current value of the stock today, what the risk-free return is. And yeah, that's correct. But you also see tech stocks being corrected with a couple of percent on their earnings calls in what we think they might yield. So, and on the long term, this is not really what is going to be the big driver of it. And I think the reset has been there for a lot of it. It's natural that if the risk-free rate goes to 10%, then that really matters. But whether it's 4 or 5% or something, that's not going to be sort of the big issue going forward. So I actually think that it's something that the market believes, and thus it becomes real. But longer term, it doesn't matter that much. What matters is whether these companies are going to be a success or not. And then you can really look at interest rates, and you can think about what they're going to be the next 3-5 years. And while that happens, the AI train just rolls along, and you see the next Google, you see the next Amazon, you see the next Apple emerge, and you're not invested because you're afraid that interest rate will be 4.5 instead of 4 or something like that.
Yeah.
So I don't think that it matters, and it's not something that you can predict. But I know that AI is coming, and I know the world is being digitized in a big way. And I also know that these stocks are undervalued because of the volatility we had in 2022. So I started to look more and more on what I think the volatility is. And when I sold a lot of our stocks 2 weeks ago because Iran was firing missiles at Israel, that was exactly that. And then that the world was at the VIX was very low, suggesting that markets think that we're in a safe place. And actually stocks has been going up for a long time. And so I don't think we're in a safe place right now. But I also think you need to be invested because AI train is going, and tech stocks are cheap.
Yeah.
Then Mads asked about how we value choose stocks in our portfolio. So we primarily try to make a broad portfolio of stocks that we believe has a low volatility long term, or a low risk on their outcome. And when they, like Fubo or like Cardlytics, have a high risk on the long-term outcome, then we have a very small position. So if we 5-double our position, it might be going from 0.2 to 1% in those stocks. And that actually tells you something about what I think about Cardlytics short term. I think there are a lot of potential triggers in it short term, and that's why it's a big position, even though that we feel that the long term risk is quite high. And then once we looked at the tech and we looked at the long term sort of trajectory for the company, then we do DCF valuations and fundamental analysis in the way that you usually do, try to figure out what is priced in by the market right now, what kind of growth rate will there be priced in, and what kind of what's the stock-based compensations look like, and what do we think exit margins will be, and then try to figure out what is priced in right now. So we do all the stuff that you usually do, but we have focus on other things as well than many other funds. They are very back end or backwards looking at earnings, and you can do that if you're in a world where rate of change is very low. But in tech where rate of change is very, very high, that the past doesn't really matter. What people are looking at for big tech right now is the future. Is search going to be a success going forward? That matters for Google. That's why Google is cheap. And all those examples. So you need to be forward looking.
Yeah. Mads, do you want to take a pick at our last question for tonight?
Yeah. What's that?
Yeah, well, that I was thinking maybe you could choose, but otherwise I'll do it.
Yeah.
So I guess we'll take Morten's question here, saying, "What's your opinion on the layoffs at Tesla and booming sales of BYD and Xpeng outside of China?"
Yeah, I think you can chime in, Jesper, and I'll just
Yeah,
give it a go here. As far as I know, then every EV company has been crushed in their sales numbers
that's right.
lately, and I think Tesla is actually doing quite okay in China, but I think that China is you shouldn't think about China probably as a long-term investor in Tesla. It's so uncertain, but I think Tesla is a car production company, and I think they're excelling at that, and they're doing really well. In their latest earnings, their gross margin per car was actually I don't know if it was the highest, but it was near the highest ever, even though they decreased car prices, and that's because their production prices has just gone down. And I think they're crushing everybody else on production efficiency. They won't be crushing China because that's what China does really well. That's production. But I also don't think that China will ever be allowed to sell EVs at scale in Europe or in North America. I just can't see it going there, that they could have all these spy cameras and computers and know where people are and stuff like that. And that's also why I don't think Tesla will be allowed to have a meaningful income in China. I think there'll go politics in it, but that's okay long term, because I don't think Tesla needs China long term for being successful. There's so much in the West, and I think that the Chinese players, they will have Central Asia, they will have Africa, they might be able to sell in Southeast Asia, some parts of Asia, but you also see Southeast Asian governments scrutinizing versus Chinese players like TikTok and Temu. So I think, yeah, I'm not very concerned about China in
Hmm.
the EV market.
Yeah.
Yes, but do fill in.
Yeah, I just lost my train of thought here, but yeah, first off, I do believe that Tesla said something like, because of all the one-time sort of issues, there have been, trouble at the Red Sea, a terrorist attack on the Berlin factory, and the ramp of the Cybertruck and the refreshed Model 3. If it hadn't been for their ability to, make more money per car, or sort of reduce costs per car, they would have been impacted way harder than they actually did. So because they were able to improve so much from just last quarter to now, it almost balanced out, despite of all these one-time sort of negative effects. To address the question directly, I do believe that layoffs were a long time coming. They do layoffs every once in a while, maybe every 5 or 4 years, and 10% reduction, I think, is also sort of the expected amount. Many speculate that it's a sign that Musk is sort of back in the driver's seat now and really starting to focus back on Tesla after X. That could be, I'm not sure, but it's definitely, according to him, because they're going hardcore now, coming out of this sort of this soft market that the whole industry has been impacted by, including the big players in China. So BYD managed to become the biggest seller of electric cars in Q4 of last year, and then Tesla ended up overtaking them again because BYD has been affected so negatively as well. So it's definitely not just a Tesla thing; it's a whole industry thing. And I'm a little bit more optimistic about Tesla's chances in China. I think there is some sort of relationship there that may be, I guess it's shrouded in mystery as well, but it's also it may perhaps be not be so well known. But Tesla is actually the first auto company ever in China to be able to operate entirely independently. All other car companies in China ever have been forced to do a joint venture to even enter the market. And somehow Elon Musk was able to not have to do this.
It's a
And
typical Elon Musk.
I guess with something like Apple, Apple has such a strong brand presence in China because they're so recognized to the whole world, that even though there are players like Huawei and Xiaomi and all the others in China, Apple is still a really successful brand in China. So I do think there's always going to be a handful of exceptions that may be able to succeed in China, regardless of all the political sort of strain that may come to it. But you are right to worry, and Mass is right as well, in the fact that if America and EU start coming after Chinese EV makers and sort of price them out of the market or put restrictions on them, the number one target doing the reverse of that is obviously going to be Tesla in China. So there's a target on their back, but I'm optimistic that they might actually handle it in some way. It could be through this new partnership with Baidu on full self-driving. Like, I guess that could be considered some sort of joint venture or state-approved move. Um, yeah, I'm sure they'll continue to have success, but obviously there could be some sort of cap on it in China due to political reasons.
Yeah, and I guess also this is just a cyclical industry, and when we're in a down cycle, this is always what it sounds like, what the press sounds like, that this is now it's bad, and now it's really going south, and
Yeah.
now you should really be wary. And when you hear the chip makers for the auto industry reporting now, it's just a really steep downturn. So it's just a business in a downturn.
Hmm.
And actually, it's been kind of weird being a tech investor with this downturn, because we've we've seen a downturn in consumer electronics, and we've seen layoffs in the tech industry. It was like they were getting a lot of funding and they were buying a lot of stuff from each other, and they were sort of in a good flywheel with each other, and then everybody started cost cutting, and like there are not as many Macs in tech companies anymore now, and therefore Apple still fewer Macs, and so it's just a flywheel, and that rolled out in 2022 and 2023, and everybody was saying, well, the car industry is holding up and stuff, and now the car industry is coming down, and yeah, so let's see if the economics might not be heading into a tough time, and maybe that could answer Mads Corfitsen's question about the rates, that maybe rates will eventually come down because the economy starts getting weaker. You could see signs of that when looking at car industry and content delivery, etc.
Yeah.
So let's see, and then that's either good for tech because rates come down, and tech was smashed because of rates going up in 2022, or the world would say that the world is going under and tech has to be cut in half as well. We don't really know, but we know that AI is coming, and it's good for our businesses. So yeah,
Yeah. I mean, if there's one thing
going
to
to be
stop
fun.
a recession or whatever coming, it should be an increase in productivity, and AI proposes that. So
Yeah,
okay,
in one
Miss.
time. Yeah,
We have some questions left over for next time, but we're gonna sign off now, and see you guys another time. We'll be sure to get to the questions we didn't get to today, the very first thing next
yeah.
time. So
Thanks for listening in, guys, and yeah, do post some questions for us on
yeah,
the social media, on the YouTube channel here. Then we'll take them next time.
definitely.
Yeah.
Have a great night. Bye, everyone.
Bye.